Good morning. This is Larry McMillan with the stock market update on Monday, July 18th, just about the time the market is opening. So things are looking a little more positive on the short term. Last week we had a strong rally on Friday, but that really isn't what I'm talking about as much as the fact that we've held in this 37.20 to 37.40 support area 7 different days recently. And so that seems to have empowered the bulls a little bit. They launched that rally on Friday. They have another rally going this morning. A couple of our indicators are nearby signals, and that would add power to this rally. And also, I think, as we mentioned last week, the bears have not really had to suffer much in recent weeks. So usually bear markets are pretty tough on everybody, including the bears. And so it might be time for that as well. The SPX chart overall in the longer term is still down, and so that's still negative, and a core bearish position is still justified. We would, if we get this rally that I'm thinking we might, the first stop would be 39.20, but a more significant area to clear would be 39.45. And then above that, close the gap at 40.17. Now, above there, you're going to run into some trouble, though, because the early trading range from early June, 40.70 to 41.70, is still there as a stronger level of resistance. And the +4 standard deviation modified Bollinger Band is at 40.50. So it's not impossible to rally through those, but that would be a more difficult task. Taking a look at some of the other indicators, you'll see that some of them are beginning to be near buy sales, and one of those is the equity-only put-call ratio. They've dropped fairly sharply recently, and they're nearing their June lows. If they cross below the June lows, that would be another buy signal. Breadth had a little bit of a hiccup last week, but the New York Stock Exchange breadth oscillator is back on a buy signal as of Friday. And the stocks only breadth oscillator is very close to a buy signal. The area that's not close to a buy signal is new highs versus new lows. New highs are still minimal. There were 9 new highs on the New York Stock Exchange on Friday, and I think 5 each of the 2 days below that. So that indicator still remains bearish. The VIX has dropped, and on Friday it dropped in advance of the weekend, of course, so sometimes it gets a little carried away with that. But VIX almost crossed below its 200-day moving average on Friday. The 200-day moving average is just above 24. So if VIX were to close below 24, that would be another, not necessarily a full-blown buy signal from the trend of VIX, but a relief of the sell signal that's in place right now. Also, the VIX spike peak buy signals are still in effect, although they are going to expire in a couple of days. Finally, the construct of volatility derivatives remains modestly positive, as it has for, well, quite some time. So overall, if we get these other couple of indicators, stocks only breadth, put-call ratios, and VIX to move through the levels that I mentioned, that would add more short-term credibility to a rally. And so we'll see if that can happen. Some of that could happen as soon as today, I suppose. Meanwhile, we are not abandoning our core bearish position, though. We will just trade these other signals around that. So I invite you to visit our website, look at our newsletters where we cover these things daily. And meanwhile, have a great week trading.